Hello and welcome. You're watching us here on Markets Today. We've spoken about the first three headlines of the day. Let's talk about the other things that made the news today. Let's talk about the fourth one. The US Federal Reserve, it's raised the benchmark interest rates by 75 basis points for the third straight time. The latest rate hike actually takes the cost of borrowing in the United States to its highest levels in the last 14 years. And the Fed has also signaled more rate hikes, probably till March next year, as it battles to tame inflation. Prashant Nair joins in with the 10 key takeaways from the Fed's commentary. Prashant.
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant on the FOMC committee is looking for another 125 basis points of hikes in the remaining two meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another two hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number five, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number six, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number seven, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number nine, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very... And this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined three conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, to summarize, I would say that this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
All right, Prashant, thanks a lot for that. With that, we go to the fifth headline for the day. Aptus Housing was the one which rallied almost 6% in an otherwise wobbly market after brokerage firm Citi bet big on the stock. It initiated coverage with the company with a buy rating. Abhishek Kothari joins in with the details of the brokerage's rationale.
Citi has initiated coverage on Aptus Value Housing with a buy recommendation and a target price of 425 per share. They say that it's a highly profitable, affordable housing leader in terms of giving small ticket size loans to affordable housing segment. It has demonstrated quality underwriting as the credit cost has been below 20 basis point pre-COVID, and even during COVID, the peak credit cost was around 86 basis point. So good execution should ensure CAGR on loan front of about 29% between FY22 to 24. Pricing power and efficient cost would structurally help in strong ROAs for the company. So they build a 60 basis point decline in net interest margin over FY22 to 24, given the fact that there will be high share of home loans as well as leverage which will kick in. So they expect an ROA of 7.4% and ROE of 16.5% for FY24. They have said that core geographies are underpenetrated, which gives scope for growth, as well as the fact that companies also foraying into new geographies which will offer growth to them. Back to you.
All right, Abhishek, thanks a lot for that. Gokaldas Exports was the other one which soared over 4% as the company is expected to be a direct beneficiary of a weaker rupee. Not just Gokaldas Exports, but a bunch of other textile companies as well. But for this one, Vahishta joins in with the key tailwinds. Vahishta.
Well, the rupee has breached its psychological mark of 80, and hence a sector like textile, which is an export-oriented sector, could be one of the biggest beneficiaries of a weaker rupee. The dollar index is already at its new all-time high. Spark Capital has initiated a coverage on Gokaldas Exports with a target price of 517 rupees, wherein Spark Capital says that revenues could grow by 43% over the next 2 years and could even double in the next 4 years on the back of a strong 480 crore capex outlay. The company's scales of operations are expected to increase significantly, and hence the company is planned to become one of the largest garment exporters of India over the next 5 years. Now, some of the catalysts for growth of the stock are India increasing its 3% share in the global woven ready-made garments trade on the back of the China Plus One strategy. Additionally, the PLI schemes on man-made fiber and some probable trade agreements. Spark Capital expects the EBITDA margins for Gokaldas Exports to expand from 10.3% in FY22 to 14% in FY26. Also, the company derives 98% of its revenues from woven garments such as outwear and casual wear, and as we know that global woven apparel consumption is already picking up, which is led by the back-to-office pent-up demand. Also, Gokaldas Exports derives 80% of its revenues from the US market, where the clothing retail sales are quite resilient at present. Additionally, Xinjiang ban has forced the large apparel exporters like Bangladesh, Vietnam, Cambodia to re-look at their supply chains, and hence some textile exporters such as Gokaldas Exports are expected to benefit.
All right, take that point. Thanks a lot for that. But problems continue for SpiceJet. The stock closed about 5% lower after the DGCA, or the Director General of Civil Aviation, extended the cap on its flights. And we learned from sources that the company may also hike staff salaries. With so much, contrasting opinion out here on SpiceJet, is the price that one has to go by. And if the price is something to go by, well, it is. Problems galore for the aviation company. Sonia Shenoy joins in with the details on SpiceJet.
So, the problems for SpiceJet continue, right? As you rightly pointed out, the DGCA, the Aviation Ministry, has asked SpiceJet to put a cap on their flights. So, only 50% of flights can fly until the 29th of October. Having put a cap on 50% of their flights means that they cannot really maximize on this travel boom that we're seeing currently, and hence you're seeing other stocks like Interglobe Aviation rise because of that. Apart from that, as we told you a couple of days ago, they had asked 80 pilots to go on leave without pay for 3 months, citing that they're looking to bring down costs. But surprisingly, sources suggest that now SpiceJet has announced a 20% salary hike for some pilots from October onwards, and they will also be depositing the TDS of all employees in the next 2 to 3 weeks. They will also be allowing employees to access their provident fund. Now, this news comes as a bit of a surprise, although it is a positive. A lot of mixed reactions coming through. On one hand, they're asking 80 pilots to go on leave without pay. On the other hand, hiking the salary of the other pilots. This doesn't bode well for the management itself and the way they are carrying out their operations. As we've been telling you, there are multiple challenges that the company is facing. The balance sheet is severely stressed for SpiceJet, and the need of the hour really is fund infusion, which is not coming through. But purely for today, the fact that the DGCA has put a further cap on the flights until the 29th of October will hamper business of SpiceJet more. But it is done for surveillance purposes because of the safety issues that SpiceJet had in the recent past. Back to you.
Sonia, thanks a lot for that. With that, we're out of time on this edition of Markets Today. Thank you so much for watching. Stay tuned to CNBC TV 18. More news and updates will continue.